please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to Commodity Champions, your weekly dose of what's brewing in the commodity space. I'm Manisha Gupta. Well, it has been a big week for the crude oil prices, where we have seen $80 being hit for the Brent crude oil prices. This has been a 4-month highs for the Brent crude oil prices. As the 4th November deadline for the Iran sanctions comes closer, we have seen the Iran exports actually continue to decline. The Iran exports are lowest since March 2016. We have seen nearly 28% of a decline as far as the Iran exports go. It was at 2 million barrels per day in the month of August, which I said is the lowest since March 2016. Well, the Iran shipments to other countries have also taken a hit at about 28% since April 2018. The ongoing crisis in the emerging market, trade war dispute and depreciating global currencies has also impacted the oil prices. Not just that, while the International Agency has warned of supply tightness, the global oil demand is expected to breach 100 million barrels per day in next 3 months. To discuss this and more, we are now joined by Azleen Ahmed, Thomas Pugh and Amartya Sen. Gentlemen, hi, thank you so much for joining us. Azleen, starting with you first, and what a week it has been, because $80 per barrel has been a resistance for some time, but we did see that level come into this week as well. Of course, there has been some resistance at those levels, but what is your sense? Once 80 is done, are we really headed further higher from these levels?
Well, I think that for the crude oil prices, we've seen quite a strength in the crude oil prices this week, and a lot of it is hinges on Iran, because what we've seen is that a lot of the countries, especially in Asia Pacific, have started to reduce their imports of Iranian crude without the promise of a waiver from the US, and I think that that will continue. So that's been a big factor that has pushed Brent up closer towards the $80. And WTI is hovering between the $69 to $70. So Iran is still a big factor in the market. And of course, Venezuelan production continues to be quite limited right now, and that's another factor.
Thomas, coming to you as well, what is your sense? With the 80 done now, the markets really seem to be preparing for higher prices from here, and that's exactly what we have seen in sense of various international bank reports as well, where they are predicting the crude oil prices anywhere to 90, 95. There's a report out on a 3-digit number as well. What is your sense?
Well, it's worth noting that we only very briefly went above 80, by a couple of cents for a few minutes. So and then we've fallen sharply back. We've fallen $2 back almost immediately. So I don't think it's clear that 80 is the kind of the new norm. We've seen prices bounce between 70 and 80 over the last few months, and I think that's likely to continue. The market seems to have priced in most of the reduction from Iran. So unless we see a significantly larger fall than expected, I expect prices to continue to trade within that kind of $70 to $80 range.
Amartya, what's your sense then? Because yes, as rightly put out by Thomas, it has been a very volatile week. We've seen a 4-month highs. We saw 2% correction yesterday. We saw the crude oil prices clawing back yet again today. With the kind of volatility that we are seeing, what are the cues you're working with, and what's also your sense on the prices going forward?
Well, I think obviously there's a lot of volatility in the market, not necessarily because of the Iran factor alone, but it's also a lot of emerging market risk with, the dollar appreciating versus the basket of fragile five. There's, of course, the trade war fears with China. Had it not been for any of these macro risks, I genuinely do believe oil prices would have been substantially higher, potentially into the 90s, if not more. I think the big thing is nobody in the market really is expecting Iranian exports to go down to zero, neither are we. But we have been more bullish than most in terms of how much we are going to lose from Iran. I mean, we believe we're going to lose 1.5 to 1.7 million barrels per day. Indications now are, including from India and China, two countries that were allegedly going to keep buying Iranian crude, that the cutbacks are going to be substantially more. So it is very possible that the Iranian exports fall below 700,000 barrels per day, which was the low point under the Obama administration. Nobody in the market is expecting that, and you can see this in the physical market. Brent very, very backwardated. Every physical crude is trading at an immense premium. That just tells you that the only reason prices haven't reached 80 is because of other concerns rather than Iran. Once we lose more barrels from Iran, I think it's only a matter of time that prices are going to go substantially higher.
All right. So, well, that of course is the first comment from all of our experts on where they expect the prices to be and what would be that one most important fundamental to watch out for. But let's take it case by case. And Azleen, coming back to you, you know, the supply side, of course, is quite important to see right now, with most people expecting a tightness as we get into the final quarter of this calendar year, especially when it comes to OPEC, because they, the agreement that the OPEC and Russia and non-OPEC companies have done, that only lasts until end of this year. So what is your sense about supplies from OPEC and Russia now?
Well, the supplies probably, in terms of a production, I think that we're going to see a period where it's going to be a very fragile balance, because obviously ahead of November, we will probably see continued decrease in Iran production. I mean, at this point, without any indications of waivers from the US, there is the possibility that Iran production or Iran exports could fall by 1.8 million barrels per day by around November from the volumes that they were exporting in May. But I think that the market is still expecting or hoping that the US will grant some waivers, so that will temper the drop in the production. In terms of supply, the IEA said in its report yesterday that spare capacity is roughly about 2.7 million barrels per day, but 60% of that is in Saudi Arabia. So there's not a huge amount of spare capacity in the market, and it's very unclear how much can quickly be brought on stream to offset the Iran drop in export. So I think in the short term, the market's going to be quite bullish until November, until there is much more clarity on the US stance in terms of what they want from Iran exports, whether they want to totally halt it or whether they will be a little bit more flexible and allow refiners, some major refiners, to at least import but at reduced volume. So I think that's going to be key in the next month, at least in terms of the crude prices.
So Azleen, in light of that, how much of a premium do you see in the crude oil prices because of the supply concerns that you just mentioned?
I think further out, we don't really see that the market's going to be that tight, because going into, I think, at the end of the year and going into 2019, if the trade disputes between the US and China and the rest and many countries continue and escalate, that will obviously have some impact on demand. I mean, at the moment, we don't think that for this year there's going to be a huge impact on in demand from the trade dispute, but that will probably be felt a lot more in 2019. So our expectations is that the market going into next year may not be as tight as we see this year, because there will be, this is assuming that Libya production will stabilize. We do think that some of the West African countries will see some steadily increased production, and some of the Middle East countries like Abu Dhabi will increase their capacity, their production capacity and their production.
Before I go back to the other experts, Azleen, I want to put this question yet back to you again. As Amrita and Thomas said, that they do not expect the crude oil prices to run away, but then just reiterating that there have been some reports suggesting a level of $90 to $95, if not this year, then 2019 perhaps. What is your own sense on prices?
I think that our expectations is that it's going to be, the band probably will stay around there. I think that unless okay, this is assuming that Iran exports will not drop to absolute zero. I think that it's going to be a little bit hard for Brent prices in particular to be sustainable at above $80 at the mid to high $80 in the short term. So I think our expectations is that $70 to $80 is still roughly where the Brent prices will probably be, and we could see slightly lower prices in the first half of 2019 compared to where we're seeing right now.
All right, that is one thing. All three of you are on the same page. But coming to you, Amrita, the supply side is something that almost everybody seems to be getting worried about, whether it is the IEA report or it is the Russian oil minister's statement saying that the geopolitical concerns are a big risk. And then, of course, it is about Venezuela, Libya. Those concerns just seem to be getting deeper. Markets also are looking at the hurricane season, which continues until 30th of November. Amongst all of this, where do you see a major threat perhaps coming across?
Sorry, what was the last bit? Do you see a major
threat coming across when in sense of supply concern?
Yeah, no, of course. And I think, like you mentioned, I mean, the biggest issue is not just Iran, right? It's basically Venezuela, but remember also Iraq, Nigeria, and Libya. They're all pretty much producing at max of their recent ranges. If there is any other outage, we just don't have the spare capacity. I mean, I'll bring the spare capacity back into the picture over here because I think it's very important to define it correctly. On paper, we might have close to 2 to 3 million barrels per day of spare capacity. But the reality is if you define something as what can be brought online in 30 days, and sustained for 90 days, I think that actual number is around 300,000 to 500,000 barrels per day. Saudi Arabia has never produced more than 10.7. It talked about going to 11 and it hasn't done that yet. They have a few expansions here and there and maybe they can expand to 11. Of course they can get to 12. Of course Russia can add another 200,000 to 300,000. But that takes time. It takes more rigs. It takes more capex. We are 9 to 12 months away from that. That's the problem. If you get another outage right now, we just don't have the global shock absorbers.
Thomas, coming to you as well, while of course the Iran sanctions is a big buzzing movement right now because we already have seen, even as the US has been talking about waivers to certain countries, we've seen certain European countries completely stop imports from Iran. Chinese imports have declined by 36%. Indian imports have gone down by 45% as well. So while of course there are other producers trying to fill that gap, what kind of a supply tightness do you think the international markets are readying themselves for?
I think the markets are probably priced in a 1 to 1.5 million barrel reduction from Iran, although it is kind of anybody's guess just how much they have. I think that we've seen Donald Trump's persistent obsession with high crude prices. And I think especially coming up to November, if we're seeing that the Iran sanctions are putting significant upward pressure on prices, if we're still at 80 or even higher towards 90, then I wouldn't be surprised if we do start to see a lot more waivers being issued, at least for the short term, to ease some of that price pressure and allow prices that US consumers will be voting in the midterm elections in November to see fall. So I wouldn't be surprised if we see a little bit of a rowback from the US.
Well, that point is very well taken. Yes, it's the elections year and they wouldn't want the crude oil prices on the higher side. But guys, please stay on with us. We will go for a very short break. When we come back, we will discuss the prices moving forward and also the demand scenario, especially for a consumer country like India, where we have seen all-time high fuel prices in much of last month. Welcome back to Commodity Champions, and this is a crude oil special where we have seen prices very, very volatile. With our guests, we of course have discussed on the supply side of it, but let's talk about the demand now. And Azleen, coming to you first, what is your sense with the global trade disputes going on and they seem far from sorted? Do you think that could be one of the factors that could weigh on demand?
I think that there is going to be, basically demand, we see demand in the second half of this year still quite strong. But basically, if the trade disputes continue and escalate, then obviously, and the US currency remains high, then there is a big risk that will have an impact on demand for oil from the emerging countries. So I think that there's still some uncertainty about how much of a demand dent this could be. There will be some, but it'll probably be felt more in 2019.
That's a fair point. Thomas, coming to you, for the consumer countries like India, while of course it has been about the currency play, the kind of depreciation that we've seen in the Indian rupee, the crude oil price is holding where they are, and of course the Indian petrol diesel prices have been hitting all-time highs for much of last fortnight. What is your sense as India being marked as, seen as the highest global growth demand country? Do you still see, with the current scenario, that as a situation that would continue?
Well, I think we're seeing kind of around the world higher prices really start to weigh on demand growth. Maybe most obviously in places like the US. But that is certainly one reason why we're kind of relatively bearish on demand over the next couple of years. The other reason is that we expect quite a sharp slowdown in major oil-consuming countries over the next 2 years, so 2019 and 2020. So I kind of agree that demand is likely to remain strong in the second half of this year. But in 2019 and 2020, we're likely to see a very kind of sharp slowdown, and oil demand growth being significantly weaker than it has been recently.
Amrita, what is your sense for many of the consumer countries? Do you see the currency play start weighing in? Because as Thomas says and as Azleen says, even with the higher prices, there's a very tough chance that we will see guzzlers like India actually see any decline at all in imports.
No, that's absolutely fair. And I think the important thing to bear in mind is that the currency effect, a lot of countries are actually shielded from it. Not India, but look at Indonesia, for instance. Currency is depreciated significantly, but the government has it subsidizes pump prices, so the consumers don't even feel the impact of it. I'd say particularly with regards to Turkey, if it becomes a bigger contagion issue for Europe, then there is going to be a big risk. Beyond that, it is going to be quite contained within a couple of countries. The trade war is a much, much bigger headwind to global economic growth. And I think that's the one worth watching, because unless and until that de-escalates, there is a risk that overall global growth slows down. Now, to try and counter that effect, China is actually embarking on a mini stimulus project, effectively. And I think that's why Chinese demand has suddenly picked up quite substantially. Gasoline markets there are incredibly tight. We've seen gasoline and diesel cargoes being imported, which hasn't happened in years. But the real issue over here really is the trade war, and we have to monitor that.
Oh, well, absolutely. Azleen, what is your sense with what's going around in the global markets? What is your sense? Because I was reading some reports that India import dependence right now is 80 to 85% and can go up to 90% in next 3 years. With the kind of situation that we are in, would you still see the India growth demand continue to be the best in the world?
Actually, I think that the higher prices, probably at where we are, there shouldn't be a big dent in the India demand growth, because we are expecting that the India demand growth is going to be very strong this year and probably next year, and even China. So I think that maybe if prices stay around, when we're talking about Brent, if prices stay around the $75 to $80, there may not be a huge impact in terms of the demand from the emerging markets like India. But if we do see prices going up towards the $90 or $100, which I think is very unlikely, in the next 6 months or next year, then I think that will have a big impact. But I think that for now, we're expecting that India demand growth will still be quite substantial.
That point is well taken. So all of you really are of the point that we're not looking at the prices run away too much. But in that sense, Thomas, coming to you first, what is the sense on prices for the coming quarter now and for rest of 2019, if you have worked on anything like that? Because for a country like India, where we have seen the rupee go the way it is, the inflation concerns are quite back. The country's economists are talking about an interest rate movement here. And of course, the US dollar. How are you looking at all of those macro scenarios now? Because that really seems to be taking some precedence.
Yeah, so we kind of think that prices are likely to remain within the current range this year, so between 70 and 80, unless we see a substantially larger than expected reduction in exports from Iran. But in 2019 and 2020, we think that substantially slower economic growth, mainly in the US, but globally, is going to lead to a significant weakening in demand for oil. We don't think that the dollar is going to play a major part. We don't see that much change there. But substantially slower growth, combined with the easing of logistical constraints in the US shale regions, means that we expect the market to be in a bit of a surplus next year, which should push prices back down. And we've penciled in $60 for Brent by the end of 2019.
Oh, well, that's an interesting one. Thomas, one more thing. How are you looking at the US dollar index going forward? Because I'm assuming you are studying that too, because currency is a strong play now.
Yeah, we think that most of the appreciation in the dollar has already happened, but we don't think it's going to fall back majorly. We've got it stable over the next couple of years, so it doesn't play a major part in our oil forecast.
Amrita, same question to you really. How are you looking at the crude oil prices for the rest of 2018? How do you see 2019 span out? And also your sense on the US dollar index?
So I would say that 2018 is the real risk, right? Like I was saying, there's the immediate lack of spare capacity is a concern, because also ultimately some waivers will be given, but before those waivers are given, companies and countries are going to be super cautious and cut back more. So it's really the tightness comes through for Q4 18. So we've always held that $80, $85 price forecast for Q4. We're going to hold on to it. If anything, there's upside risk to that. Next year, the first half of the year will be extremely tight, particularly as Iran goes off the market. But second half, from Q3 onwards, you should start to see more U.S. production coming through, because right now they're completely infrastructure constrained. And then you're going to get more production from Saudi Arabia, UAE as well, and Russia. So that helps a little bit. We've already got a pretty weak demand profile for next year, only expecting growth of about 1.2 million barrels per day year on year. But, the real risk over here to the upside is IMO 2020, which is the bunker specification change that's coming through from 1st of January. And you will start to see the market trading and pricing that in from the second half of 19. You're effectively going to get a significant boost to demand, because fuel oil prices have to go down, and you're going to see power generation pulling in oil again. It's complicated, so I don't want to necessarily go into this for everybody, but the reality is that IMO 2020 is going to be quite bullish for prices, because we are going to get more demand for oil, and particularly clean products such as diesel and gasoline. And that's going to offset a lot of the kind of increased supplies, and I think that's definitely one to watch out for.
All right, so plenty of concerns outside in the market there and uncertainties as well. But one thing that our experts are on page one is about stronger crude oil prices and more volatile in this year. Next year, second half, of course, is a time that you could see some more decline continuing in case of the crude oil prices. But until then, a consumer country like India really will have to be on the edge with the kind of other global cues as well that we are facing. With that, Azleen, Thomas and Amrita, thank you so much for taking time out for us today and discussing the most important subject that the country is watching, and that, of course, is the crude oil prices. With that, that's all the time that we have on Commodity Champions. Thank you for watching.